let's have a look at technical analysis. So after we've done our fundamentals, we need to go technicals, and that's where was the highest point, about 65 here, and after that it's keep going down, and it's made couple rolls, 1, 2, 3, and now we can see it's kind of moving on a smaller uptrend. Okay, now remember that whole industry, like not industry, index right now, whole market is high. So, and I wouldn't be surprised. Look at this part, okay? You can see this part, and look at this part. Really similar, right? They're kind of identical. So, and what can happen here? That can have another roll, or it can have this type of jump down. Same. I think it was Brexit here, and so it might have similar when the market pulls down. So it might still touch this support level one more time. So it can go to $48. I wouldn't be surprised if it goes to $48 somewhere, and I might pick up shares on that level. But it might stay here and then to continue go, and even if it continued downtrend, it still might go to about $57. Maybe if it goes to this level, about $60 level. Okay, so it has about potential growth about 15 to 20% here from this point. Okay, and that's important to understand. Why? Because based on technical analysis, we're going to implement our strategies, our whatever strategy you're going to use. Okay, so let's have a look. Now, we discussed it yesterday about that you have to base your strategy on your own personality. It's one thing. So the strategy which you feel comfortable with. It's secondly, you have to pay attention to your knowledge level. So if you understand options, you use options. If you don't fully understand them, maybe you need to learn more about that. If you're more like a value investor, a long-term guy, so you use one strategy. If you're a trader, you use another strategy. So you have to take into account your own personal circumstances before you decide what strategy you're going to use. I'm going to list few of them here, and then you can think how you can adjust it. They're not precise because right now the price is not at the point where I would buy it, okay, personally. So let's have a look, value investing. So I told you, if we buy it even on a long term for 2 to 3, 5 years, I still will wait maybe another week too until market moves down. It will give us an opportunity to buy it cheaper. So and very possible that you can pick these shares at $47 level. Okay, and actually let's have a look when they have earnings. Just a second, I missed. They have earnings 22nd of December. Okay, so and remember that would be the worst quarter for them, and it depends how people react on that. So maybe it will move the share price even lower, so and you will be able to pick the share lower. But believe me, the company is pretty good, and at the moment it's quite low, so it might never happen. The share price might move up. So you have to think about what you decide. Now, so if you buy it at $47 to $50 level and then hold until 65 to 90, right? So it might take about 1 to 2 years, and it might give you from 30 to 80% profit. Plus you get some dividends on the top of that. So that's one strategy, you buy a hold. If you use value trading, so we buy it at the same level and then buy it on a roll. So when it comes to the resistance level, and we saw it on technical analysis, it's about 56 to 60. There are two resistance levels. So if we go on downtrend, it's about here, 56. If it breaks through, so the next resistance, it would be here. So on a previous stop, so it's going to be about $60 level. So, and that's where you can sell it. Now, of course, it can go higher, but most likely it will bounce from those levels down. And if you trader, you can sell them here, and then you can buy them cheaper again. Another strategy using call and put options. So call options, again, when you even use call option strategy, you still want to buy shares at the lowest level, at support. Okay, when you buy at 47.50, then you wait until it goes a bit higher, and then you can sell the call. Okay, and by doing this, you get a maximum profit. And for example, here I looked at levels which we can receive, right? So what strike price did I take here? $51 and $51 133. I looked at this. It's until 23rd of January, right? That's what we can get. But remember that 22nd of January they have earnings, so it's after the earnings. Okay, but you can get $1.33 with a strike price 51. So that's why if it drops down and then moves up, you can get 1.3, or if you wait until it goes another dollar up, you can get some intrinsic value as well. So you can get more, okay, and it might move from 2.6 to 4 or 5 or even higher profitability on this particular case. So that's covered call strategy. Do you understand about this covered call, how you deal with it? All right, Ian, I will explain one more time. So it means what happens that, for example, you can see here when it touch this support line, that's why we buy shares. And we don't sell the call instantly. We don't sell it. What we do, we wait until it comes up. And when we see that it start turning around, instead of selling shares, like assuming you want to keep those shares, you sell the covered call with a strike price, maybe 51 in the money. So even if the share is at $52 level, you might get $2.50 because $1 would be a difference between 52 and 51. And then you get some time value. And then when the share goes back to around $50 level, it might expire worthless. So you keep all the money, or you might buy this call back at the bottom level for the lower price and you fix your profit. And then whenever it moves up again, you sell another call. So that's a covered call strategy. Have a look one more time in our in the module which follows the covered call strategy. If still something unclear, we can get on Skype and I can explain you in more details. Naked puts. When do you sell naked puts? You only sell naked puts when you're happy to own the shares. So instead of just buying stock at this particular price, what you can do, you can sell the put. So you give somebody the right to sell your shares at a certain price. So for example, if we look at right now and sell $51 put, we could get $1.95 or even high. It depends again. So if at current levels, what's this? That's put and $51 until 23rd, we can get $1.95. So who can tell me now, if we get $1.95 upfront for selling put, $51 strike put, right? And then we buy it at $51. What's real price for our shares will be? Like break-even price. Who can tell me? Or all try to tell me. Yeah, that's right. 49.05, right? So we need to deduct from 51. We deduct 195. We get 49.05 cents. That would be our break-even price. So even though the share price right now at $51 level, it's like you're picking up it's at a much cheaper price. Okay, and if you are patient and you wait until the share price goes to let's say $50 level or $49 level or even $47 level, and you sell $51 put, at least you have to get time or intrinsic value. So it's a difference. So for example, if the share price is $49 when it goes there and you're selling still $51 put, you have to get at least $2. That's the difference because you're promising to buy $2 higher than the price will be at that particular moment. And then you have to get some time value as well. So you might get $2 or $3 or even higher. Okay, and it will increase your rate of return when the share price moves back up. Okay, so that's would make it pulse. That's your strategy. Do you understand how it works? Put please if you do. or minus if you don't. Okay, good. Now, Ian, if you not fully understand, I recommend to practice on simulator, and Dean as well. I understand what happens. Like always try to do, it's like you're buying shares in a bargain. Always only sell puts when you are happy to own the shares. That's have to be rule number one always. So if you are happy to buy, let's say Nike, and you're happy to pay for this $51, you instead of buying at $51, you just sell put, because if you uh, if somebody sold these shares to you, okay, you're going to have them at lower price because you keep this $1.95. It's what Peter said last yesterday, yeah, when he said that he did it with a sell comfort, yeah, and they moved up, and he ended up keeping money because if you sold the put and the share price ended up above $51, nobody's going to sell you at 51, so you just keep the money. That's the beauty of selling puts. Sometimes you don't have to even buy anything, okay, so you just get pure cash.